Michael Burry, the hedge fund manager portrayed in The Big Short, gained fame for predicting the collapse of the US housing market before the 2008 financial crisis. Rather than shorting stocks or mortgage-backed securities directly, Burry used credit default swaps and long-dated put options to profit from a market downturn. Put options allowed him to gain as the value of housing-related securities fell, while limiting his downside risk to the premium paid for the options. This strategy showcased the power of options, the ability to achieve significant returns from relatively small investments through carefully constructed asymmetric risk profiles. His success is a powerful illustration of how options, when properly understood and deployed, can serve as effective tools for hedging, speculation, and capturing market inefficiencies. An option is a financial contract that provides the buyer the right but not the obligation to buy, call, or sell, put an underlying asset at a specified price on or before a specified date. Options are derivatives. Their value is derived from the price of another asset, such as a stock, index, or commodity. Options are used for hedging existing positions, speculating on price movements, and generating income through premium collection. Options can be traded on regulated exchanges, standardized, or over-the-counter, customized. Call options grant the holder the right to buy an asset at a predetermined price, strike price. Put options grant the holder the right to sell an asset at the strike price. Example: if you buy a call option on stock Tesla with a strike price of $400 for $15, at maturity, if Tesla closes at $450, your payout is $450 minus $400 equals $50, and your profit is $50 minus $15 equals $35. If Tesla closes at $300, you don't exercise and your payout is $0, and your loss is your premium, $15. Strike price is the agreed price at which the asset can be bought or sold. Expiration date is the final date the option can be exercised. Premium is the price paid to acquire the option. Intrinsic value is the difference between asset price and strike, if favorable. Time value is the portion of the premium related to time until expiration. ITM, ATM, and OTM, in the money, at the money, and out of the money, indicate moneyness. Call option buyer has unlimited upside potential and maximum loss limited to the premium. Put option buyer sees maximum gain if the asset drops significantly and loss is limited to the premium. Call option writer receives premium but faces unlimited risk if the asset price rises. Put option writer profits if price stays above strike but faces high risk if asset price crashes. These profiles can be plotted graphically as payoff diagrams, a vital tool for understanding options behavior. Portfolio insurance involves buying protective puts to hedge a stock portfolio. Leveraged speculation uses call options to bet on a price surge with minimal capital. Yield enhancement is achieved by selling covered calls to generate income from stock holdings. Directional bets allow investors to express bullish or bearish views without large capital outlays. Options provide customizable exposure to market outcomes, making them essential tools in both institutional and retail strategies. Options empower investors to fine-tune their market exposure, hedge existing risks, or speculate with defined downside. But this power comes with complexity. Options require a solid grasp of their mechanics, payoff profiles, and the risks associated with both buying and writing contracts. In this module, we will explore how options work in detail, from the Greeks and pricing models to real-world trading strategies that apply these concepts across different market conditions.